One of the biggest secrets to building wealth is understanding how to make money work for you. Imagine no longer need to grind every day. Wealthy people get this. They invest and letting their money grow on its own. Now, if you want to build money the fast way, investing is one of the smartest way to start. In today's video, I will take you through 3 powerful investment options that can put you on the path to growing your wealth smarter and faster. Now, to kick things off, let's look at 2 essential ETFs for the long-term investor. VOO and SCHD. Why these? Each brings something different to the table, and both have a great return over the long term. So, what makes SCHD so attractive? First, SCHD offers a dividend yield of 3.6%, providing a steady income stream for investors looking for regular cash flow. And this is especially attractive for retirees who rely on income from their investments. With low interest rates making bonds less appealing, SCHD becomes an excellent alternative for those seeking reliable income and growth. And with a low expense ratio of 0.06%, SCHD keeps costs minimal, maximizing your net return. SCHD has delivered a strong 10-year return of 11.7% per year, offering a rare combination of stability and growth. It has broad diversification and it holds over 100 companies with sectors like financials, healthcare, consumer staples, and this sector diversification adds an extra layer of stability. So in short, SCHD provides steady dividend income along with growth potential, making it an excellent choice for those looking to generate income during retirement. One of the main reasons I'm a fan of SCHD is that it focuses on stable dividend paying companies that typically perform better when the markets drop. This makes SCHD a safer, more reliable choice during uncertain times. Now, let's switch gears to VOO, an ETF that focuses purely on growth through large cap US companies. If you are more growth driven, for example, VOO could be a better choice. VOO's impressive 10 years average annual return of 12.9% highlights the strong potential of top US companies to drive steady long-term growth. When we look to the cost, one of VOO's big advantages is its ultra low expense ratio of just 0.03%. For long-term investors, this keeps more of your returns in your pocket, and like I've mentioned in other videos as well, this is one of the most important factors when you are looking for returns. VOO holds over 500 stocks across multiple sectors with roughly a third in information technology. But here's also a very important thing. Nearly 30% of VOO's holdings are in a magnificent 7, like Apple, Microsoft, Amazon, Alphabet, Meta, Nvidia, and Tesla. And this concentration offers a strong growth, but also comes with some unique risks. So VOO is a powerful choice for long-term growth, but it's heavily reliant on tech stocks. So it's important to know that a downturn among these top tech players could affect its performance. So while VOO's sector diversification is broad, there is a unique concentration risk here, right? Almost 30% of the index value sits in just 7 tech giants. That means if these companies slow down, the index may take a hit, even if other companies perform well. And this is also what projected recently. They say that the performance of these large companies may lag behind in the future, as I've discussed in this video. Now, if you are concerned about this reliance on a few major players, consider an equal weighted S&P 500 like RSP, Invesco S&P 500 equal weight ETF. Unlike the traditional S&P 500, which is weighted by market cap, an equal weighted approach means each company has the same influence, no matter its size. And this setup spreads risk more evenly, so smaller companies have a choice to drive performance. And here you could also benefit from it too. I once had a client who was convinced that buying only the best companies would guarantee he would always outperform the market. He focused solely on a handful of leading stocks and avoided diversification. And for a while it worked. His portfolio outperformed the market. However, after a couple of years, things changed. Other stocks from different sectors started to perform better, and his portfolio began to lag behind. And that's when I shared this lesson with him, the importance of diversification. I explained that it's not about betting on just a few companies, but spreading the risk across many companies so you get the average return. And that's why I'm such a fan of ETFs. They offer that broad exposure while still giving you strong returns without a hassle. Now, let's go back to the equal weighted S&P 500 ETF, the RSP. Over the last 10 years, VOO has outperformed RSP by an average of 2% per year. So this means that on average, VOO has delivered higher returns annually compared to RSP over the last decade. But just like my client learned, the real question is what will happen over the next 10 years? Because past performance is not a guarantee of future returns, and the market is always changing. Well, one ETF may outperformed in the past, things could look very different moving forward, right? So, bottom line, equal weighted ETFs like RSP are worth exploring if you would like to spread your exposure more evenly and reduce reliance on a few top companies. That's why diversification is so important. It helps protect against the uncertainty of the future. And by diversifying across various ETFs, you can lower your risk and avoid leaning too heavily on any single sector. So for those wanting an even broader slice of the US market, let me introduce you to the VTI, the Vanguard Total Stock Market ETF. Unlike VOO, which focuses on large cap companies, VTI includes small, mid and large cap stocks, giving you exposure to the full US market with over 3,600 companies. VTI covers all sectors and all sizes of US companies from the giants down to smaller firms, giving you an extra layer of diversification. With this broader exposure, VTI is less influenced by a few big players. This can provide a more balanced performance, especially when small and mid-cap stocks doing well. So in summary, VTI can complement VOO, RSP or SCHD by giving you broad exposure across the entire US stock market, from the biggest companies to the smallest players. And remember, you don't have to choose one ETF, you can also choose 2 or 3 ETFs to spread your risk. Now, you might be wondering, how do wealthy people build their fortunes so quickly? For what I have seen after guiding wealthy people over 15 years in the financial industry, it's not about working harder or longer hours. It's about making your money work for you. And in this video, rich people do this to build wealth fast. It's kind of a secret. We are going to dive into the smart strategies that wealthy people use, like Jim Carrey, to grow his wealth smarter and faster. And trust me, you won't expect this one. See you in the next video.